for today's topic, because today's topic we are going to be talking about taxes. Now, we have talked a lot about taxes throughout these other seminars. We have talked about the screen that you see on the screen that you're looking at right now. We have seen this before, and we know about future taxes. And if we assume or if we feel or think that taxes are going to go up in the future, then there's a lot to be said about possibly paying your taxes now. And so we've had that conversation as it pertains to the initial training topic that we went over, because how this affects your investments and the growth is very important. We also talked about this a lot last week in the qualified plan training. So make sure that you review that. As you can see, just a quick review, if you have $1 million in a 401k, for example, you may think you have $1 million, but the reality of it is if you're in a 30% tax bracket, then the IRS actually owns $300,000 of that. Your share is $700,000. If taxes go up to even where the average line is, then there's a very good chance that the IRS ends up owning more money than you do. So once again, just a quick review, this can very significantly impact the growth of your money. Once again, you've noticed we haven't talked a lot about rate of return, because rate of return is important. However, there are a lot of other things that affect the rate of return, like the taxes and the fees and these impact of losses and things like that. So make sure that you understand exactly how that works. Now, what I want to talk about today is a different topic related to taxes, and I want to understand how taxes are generated in a taxable account and how that affects the growth of your money. I once met with a client who had just sold some real estate, and he was sitting on, I don't know, $2 or $4 million bucks, I think it was, $2 million, I think. And I asked him what his perfect investment looked like. And he said, I would love it if I could get like an 8% return in the bank, at the bank, in the savings account, of course, because it would be safe, it would be guaranteed, and it would be a good rate of return. Well, what he, of course, wasn't considering when he was thinking about that was, of course, how that would look from a tax standpoint. Now, this is very common with a lot of wealthy individuals and a lot of higher net worth clients, because they a lot of times have maxed out their qualified plans, and so they have money in these taxable accounts. And it's very important to understand how these taxes affect the growth of the money. So with that being said, there are a couple of things that you can do when you run into a situation like this. But let's kind of go with our initial assumptions. Let's review our information that we're going to start with. For example, let's just take a client that is 55 years old, that has 30 years. Maybe the life expectancy is 85, 90, so we've got at least a good 30 years there. So a 55-year-old with $1 million in a taxable account. This could be in a CD at the bank. This could be in a savings account. This could be in an equity account, in stock, bonds, whatever the case may be. Let's just say they have $1 million, and let's say they are getting 6% on that money. Now, I know that a CD is currently not paying 6%. However, they have in the past, and there's a very good chance that they will in the future. But you could also be looking at a 6% return on your equity account. Now, once again, review the impact of losses and things like that, and you can decide whether or not this is accurate or whether this is a little generous, probably a little generous. But let's just say, for easy math, that they are getting a 6% on their current account. They're getting a 6% on the account that we are going to show them, and let's just say that their opportunity cost, of course, would therefore be 6%. So we'll just keep it simple with 6% across the board. Now, if they are in a CD and they are getting 1%, then, of course, this conversation is going to be a lot easier if we are going to be able to get them, 6% in a different account, which, of course, would be the opportunity cost. So let's just keep it simple, and let's just give it 6% across the board on all accounts. Now, let's just say they are in a 30% tax bracket. My experience in working with individuals with this kind of a net worth, they're probably closer to 35 or 40% tax bracket, because they are probably in the highest tax bracket, and that, between state and federal, you could be a little higher than that. But let's just be generous once again and put them in a 30% tax bracket. And let's just say in the future they are still in a 30% tax bracket. Like I just mentioned a minute ago, there's a good chance the taxes will go up in the future, but let's just say for now that these are the numbers that we are dealing with. Okay, so we'll first start out with the conversation of compound interest. I've read several books, and I remember being trained on the Rule of 72 and all sorts of things about compound interest. You can go online and you can find all sorts of calculators, and you can get really excited about compound interest and how that affects your money, and how that $1 million that grows at 6% over a 30-year period of time could be, of course, $5.7 million. Now, that's with the very basics. That's from a calculator standpoint. That is not looking, of course, at all of the information that impacts the growth of that money. That, of course, does not factor in the impact of losses, and that, of course, definitely does not include the fees that are going along with that 6% account there, and it definitely does not include the taxes that you have to pay on that account if it is in a taxable account. But once again, just for simplicity, let's just look at $1 million that could grow to 5.7, best case scenario with no fees, no losses, and no taxes. So that's your best case scenario right there at a 5.7 over 30 years. Now, the option that we need to look at is the fact that your taxes also increase and grow right along with that investment, because if we are in a 30% tax bracket and we have this $1 million at a 6% return, as you can see on the far left, as that money grows, we still end up with the same $5.7 million that we just saw a minute ago. However, if you were to ask most of these clients how they pay for their taxes each year, like let's go back up to year one, in year one, they are going to owe $18,000 in taxes. If you ask most of these clients, they are going to say that they just pay that out of their income. They just pay that out of their pocket each year. That usually doesn't even come out of that $1 million account. And so that's just what they're paying on an annual basis. So, as you can see, in year one, at a 30% tax bracket, they have a tax bill due that year of $18,000. If you look at that over a 5-year period of time, now that my account has grown, my tax liability has grown right along with that. So now that year, I owe $22,000 in taxes, $22,725 instead of $18,000. So cumulative over 5 years, I've now paid a total of $101,000 in taxes. Now, in the very beginning, the first thing that we teach people is what we call opportunity cost. And opportunity cost is simply this. If you're paying $22,000 in taxes, or in this case, $100,000 in taxes, it doesn't just cost you $100,000. Because if you could get a 6% investment, or 6% on your investment, then if you didn't have to pay that $100,000, then that $100,000 could be earning the 6%. So we have to calculate the lost opportunity cost on our money. So in year one, if we look at that, the money that we are paying in taxes each year could have been invested. So going down to that same 5 years, had we invested that $100,000 over that time frame at a 6% return, that could have been $12,000. That is our opportunity cost that we lost by having to pay those taxes. So fast forward 20 years, that's $427,000 that we could have earned on the $662,000. That's just interest that we could have earned on the $662,000 that we had to pay in taxes. So if we actually look at over that same 30-year period of time, it's not $5.7 million that we have. It's actually a net balance of about $2.8 million, because we had to pay $1.4 million in taxes, and we lost $1.5 million in opportunity costs along the way. So once again, very few people ever get all the facts. That's why when we talked about mortgages, it's not just the interest that you're paying, but you got to consider the taxes that you're saving on that on that mortgage interest. And you have to, of course, consider the opportunity cost that you're losing on that mortgage payment. So if you're looking at a higher, a 15-year mortgage over a 30, you have to look at the opportunity cost on all that extra money. So opportunity cost is very real. It's a very real, factor in the growth of your money, and we always have to consider that and look at that. So in this particular case, as you can see, it's not 5.7 that our calculator told us. The rule of 72 isn't going to be extremely accurate in this particular scenario. And of course, we haven't even discussed, losses or fees in all of this. We are simply just looking at how taxes takes a huge chunk out of the growth of our money, especially when we are looking at a taxable account. So very important and something to consider. So what are our choices? How do we solve this? We know what the problem is. How do we solve it? Well, first of all, there's the flat alternative tax, where flat tax alternative, where basically you just take the interest and move that over, which we'll look at that. And then, of course, the second one is you reduce that principal over time, which, of course, reduces the taxes as well. But let's look at the first one, which is the flat tax alternative. Now, with the flat tax alternative, what we are going to do is we're going to show you how we take the interest from that account and move that over into a tax deferred account or a tax favored account. We'll kind of look at both. So let's take a look here at that scenario. Now, there's a lot of numbers in all of this, and so I want to kind of review this and make sure that we're going through this in a way that everyone understands it. But watch this over on the far left, and feel free to text or put comments in your GoToWebinar panel if you have any questions on this. But in the far left, I'm just going to go real quick and then I'll come back. But watch that $1 million. It never grows. It never changed. Okay, the entire time it simply stayed the same. We never increased that $1 million on the far left, that green there. Now, what we did is we took that 56,000 that you can see there. We took that 56,000, okay, and we are going to move that interest, we are going to move that over here into this account too. But first of all, once again, as you can see there on tax 1, we've got the same 30% tax bracket that doesn't stay or doesn't change. And then, of course, we've got the annual taxes paid. Notice that the annual taxes didn't change for the 30 years because if we stayed in a 30% tax bracket the whole 30 years, that's why it's kind of a steady line there. If our 30% stayed the entire time, then all we're doing is paying $16,000 or almost $17,000 every year on that $1 million balance. And so, as you can see, over 30 years, we've paid $833,000 in, $509,000 in taxes. And of course, if we would have invested that $509,000, we could have had an additional, some additional interest for a total of $833,000. Now, what if we were to put that over into that $56,000 each year? What if we were to take that interest each year and move that over into a tax-deferred account? Okay, so now all of a sudden in year 1, we have $56,000 now over here in account number 2. So we're taking their existing money and we're moving just the interest. In this case, $56,000. $56,000 a year. Okay, so we move that $56,000 over here. That account also gets 6%. And so you've got $3,300, almost $3,400 in interest in just year 1 alone. Okay, so now as you can see, if we go out over a 5-year period of time here, we have taken $56,000 a year for 5 years now. We've moved it over here, so now we have $319,000 with, of course, some interest that we've earned on that money, and we're up to a $338,000 balance in that account. We have deferred $16,000, which the benefit of that is that we did not lose the opportunity cost of that money. That money remained in our account. That's what tax deferred means. That means that all of that money that we would have paid in taxes gets to stay in our account and earn interest. So that is a very important, that's a very important thing to consider here. So now, of course, if we look at this over time, and we take just that interest, we are looking at a net balance of 3.4, almost $3.5 million. Just by moving the interest and leaving that $1 million, we're at that. So let's say in this particular case, let's say somebody needs to keep that $1 million, and they need to have at least $1 million in that account for whatever reason. Well, even if we just move the interest of that account over, then we could start to build up some money into a second account, like in account number 2. Maybe it's a business owner that has an account that they need to have liquid and that they need to have available. That's fine. We could leave that $1 million there, but we could just move the interest each year over into a tax-deferred account. But what I want to highlight, to summarize, is I want to highlight that down here we have 3.4, almost 3.8 in kind of a net gain on that money. So that's our net return, I should say, on that original $1 million. So 3.4, almost 3.5. Whereas if we came back, just to go back real quick, and looked at this particular scenario where we just left things where it's at, it's only 2.8. So we are talking about literally going from a 2.8 net return on that account, from a 2.8 net return to a 3.4 just by moving that money across. Now that is why we call this a major wealth transfer. This is money that they are transferring away unknowingly and unnecessarily, but it is real money. That is real money that you can put back into their pocket. So that is definitely a very good option, which is just to move the interest. Now, here's another option. Let's say that we're going to take that $1 million, and with the stroke of a pen, we're just going to move that right over into a tax-deferred account, the entire $1 million. So now, instead of just the interest each year, we are going to move the entire $1 million over into a tax-deferred account. So as you can see down here, we take at the beginning that $1 million, and we move it over. So notice everything is zero. Taxes paid, opportunity cost, you lost, everything's zero, because we just literally transferred the money. So now we're over here into account number 2 with the $1 million, and of course it's at a 6% still. So 6% of $1 million is an easy math, so 60,000. So we can see that, of course, in year 1 we have $1,060,000, and the taxes deferred already are $18,000. So of course our net account balance just in year 1 is $1,042,000, which is, of course, the $1 million plus the $60,000 in interest, right? And of course the taxes deferred of $18,000. Okay, so now if we look at that, there's our money being moved over, the $1 million being moved over into account number 2. And as we look at that over time, going back, let's go back to our 5-year mark. And in 5 years, of course, we have deferred $101,000. Notice that over here, we're not losing money. We're not paying extra taxes over here because we moved it all over into a tax-deferred account. Now, there are a couple of different types of accounts. One is a tax-deferred account, and as you can see, we're deferring those taxes. But of course, you know, we do have to pay those, but we're getting opportunity cost. We're not losing the opportunity cost on that money. So if we look at it over a 30-year period of time, now we're up to $4.3 million is our net balance if we look at the accounts minus the taxes and opportunity costs. So as you can see, we're getting a lot more of a net gain here by, with one swoop, moving that over into a tax-deferred account. Now, could we also move it over into a tax-favored account? Yes, but generally speaking, not in one swoop, but just for illustration purposes, let's show you what that looks like. And you're going to, of course, need to consult a financial professional on the details of how this works. But if we look at that over this same period of time, in a tax-favored account, notice the only thing that changed is my tax deferred. We are not deferring taxes. We are in a tax-favored account, meaning it grows tax deferred and we don't have a future tax liability in the future, which means now we are at a 5.7 actual gain on our money. Now, of course, once again, for all fairness, we have not factored in fees in this, but we have not factored in, any sort of impact of loss or anything like that. If that is an option, which depending on the vehicles that you choose, of course, we can avoid losses, and but of course there will always be fees associated with whatever you do. But just mathematically, as you can see how this works, we are deferring those taxes, or in a tax-favored account, we don't pay the taxes at all. They've already been paid previously, so we've already had those taxes paid. So now, that's one option. But like I said, in some cases, it's a little difficult just with one big chunk to move, all the money over into a tax-favored account. So, and for whatever reason, let's say that even back in a tax-deferred account, let's say somebody wants to move the money over in a 5-year period of time. Well, how this looks now is we do have, of course, some taxes that we've paid over here, and we have some lost opportunity costs on those taxes paid, but we keep that to a minimum. So we paid down that account. So we took that $1 million of principal and we paid it down over 5 years. And by paying that down over 5 years and moving that money over here into our tax-deferred account, as you can see, we deferred a lot of taxes, and of course, we grew a majority of it into this tax-deferred account. Now, once again, if we did that same thing into a tax-favored account instead of just a tax-deferred account, now all of a sudden we're moving all that money over a 5-year period of time into this tax-favored account. And now, of course, we have all of that money. We're at $5.5 million. Maybe not quite the 5.7 because we did have to pay some taxes, but as you can see, the faster we do it, the more we have. So instead of 5.5, if we took 10 years to pay that down, we're at a 5.3. So lesson learned here is the faster we can move that money, the better. So our goal, of course, is to move that money over as quick as possible. Now, I just want to point out a couple really popular options for this. Tax-favored, very commonly could be a life insurance type account. And of course, tax-deferred could be a type of annuity. So annuities have tax deferral. Life insurance are tax-favored. So just to kind of give you the difference between a couple of vehicles, even though, of course, we're focused more on the golf swing than we are the golf club, just so you know, those are a couple of very common golf clubs that we can use in this scenario. Okay? Now, to summarize, as you can see, we have several options. And what I love about what it is that we do is that we can give the client options. It doesn't matter what they decide to do as long as they have all the facts. They might have circumstances, that requires them to pay it down over 10 years instead of over 5. Or maybe they need to keep that balance where it's at and they can only move over the interest, and so we have a flat tax scenario. But either way, as they can see very clearly with this illustration, the increased tax scenario that they're in right now is not the most effective. They have no deferred taxes, so they're paying taxes every year. They're losing a ton of opportunity costs on the money. And as you can see, the taxes paid from the lifestyle, they're actually paying that out of their pocket. So their net account balance is $2.8 million. Very easy to go across and look at this and see that the immediate pay down is always the most effective and the fastest. So in other words, the faster you can move the money, the better to get that tax deferral. So the improvement is listed there at the bottom. Now, with the tax-favored accounts, it's an even bigger impact to be able to move that over. Like in this particular case, there's a reducing the taxes over a 10-year period of time, for example, as a $2.5 million improvement. So there's a lot to consider when we're looking at like a tax-favored account. Just to point out, just so you know, under the current tax law, the IRS limits opportunities for an immediate pay down to provide that tax-free disbursement. So sometimes that's why a lot of proper planning ahead of time could be helpful. Like, for example, if you know somebody that is going to be selling a business down the road or receiving an inheritance down the road, there are some things that we can do to plan ahead of time to allow for a big chunk of money to go into a tax-favored account. So there's a lot of planning that we can do when it comes to the details of all this, but in this particular training, I just wanted to go over the details of taxes and how that affects the growth of your money. I thought it would be fun just to see at the end how this might apply in a real-world scenario. So I've got just some real-world scenario numbers to throw in here just so I can show you how something like this might look by taking, in this particular case, I had 1.1 million, okay, and I am going to give this an 8.3, I think it was, hang on just a sec, 8.36, and I'm going to show you an actual real life example of what this would look like, 8.36. Now, this is going to assume that you're getting 8.36 in a savings account with no fees whatsoever, 8.36 in a savings account or a CD, but of course you are going to pay your taxes at a 30% tax bracket, okay? So no fees and no losses. This is linear. This is a calculator type, 8.36 linear every single year. And as we can see, over a 20-year period of time, that net account balance, hold on just a second. Oh, hold on. In this particular case, I was using 40 because of this particular scenario. Hold on. In this particular scenario, this was a real-world example, and they were in a 40% tax bracket. So in 20-year period of time, at an 8.6 or 8.36% return, their net account balance was 2.7. So I took that exact same return of 8.36 and I put it into a tax-favored account, and I did it over a 5-year period of time. So over a 5-year period of time, I took that money and paid it down, which we could actually look at that reduced scenario in just a second. But this, of course, doesn't have the advantage of having all 1.1 million right away to start earning interest. It takes 5 years before this can start earning interest, okay? And this, of course, is in a life insurance account with the same rate of return illustrated. But, of course, there are fees that come out. And if you remember, Doug talked about the importance of fees and how there's increasing fees versus getting the fees out in the beginning. But look at what happens in 20 years. Okay? In 20 years, the surrender value is 2.7, or 2.9, sorry, 2.9. And as we could look back over here, 2.9 versus 2.7. If they're in a 40% tax bracket with a no-fee scenario. But just to show you the impact of taxes and how that affects the growth of that money. So now coming back over here, 2.9 plus, a little bit of, now in this particular case, we're paying down the death benefit for the efficiency now. But I want to come ahead to 30 years down the road at 6.3 million versus over here, 30 years down the road, 3.8. So over a 30-year time frame, by having 1.1 increase in an 8.3 account, and this was years ago. I remember running this illustration because it was the client I was telling you earlier. They had more than this, but this was just one particular scenario. But anyway, they had this chunk of money that they wanted to look at, and I asked them what the perfect scenario was, and they said an 8% return in a savings account with no fees. And everyone gets so focused on fees that they don't understand how taxes can impact their situation. He happened to be in a 40% tax bracket. So as you can see here, 8.3 over 30 years is $12 million when you're looking at it from a calculator standpoint. But if you look at all of the taxes that you're paying all those years out of your pocket, and all the opportunity costs that you're losing on all those taxes you're paying all those years, the net is only 3.8. And in our particular scenario here, we're at 6.3. And of course, that money is tax favored, meaning that you have access to it tax-free. You've already paid your taxes on all this money, so it grew tax deferred, and you got to pull it out tax-free. Very powerful scenario to look at. We, of course, could come over here and just to kind of show you how this works, we could come over here and do something very similar in a pay down scenario, okay? And we could do over 5 years. We could do that same 1.1 million, okay? There's your, in this case, it's a little different, but it's very similar. We look at this over 20 years. I'd have to adjust the numbers just a little bit, but you get the idea. 2.7 million in this particular account, instead of what we were just looking at a minute ago was 2.9. And then if we look at it over 30 years, of course, 4.6 in this account versus the 6 plus that we had over here. So real world example, just to kind of show you how this works when we include fees compared to an account without fees. And of course, we all know that the banks are not currently paying 8.3, so this is even that much more powerful to consider. So hopefully this helps you to understand what an impact taxes have, what the impact taxes has on the growth of your money. And with that being said, thank you for your time. Without any, let me just check real quick for questions. It doesn't look like we have any questions, so thanks again for your time. Have a great day, and take care. We'll see you next week.